Good morning, friends. This is the 0DTE morning market analysis. And what are we looking at? We are looking at the options chain for today's expiration on the SPX. And why are we looking at that? Why are we looking at such a boring, flashing set of green and red and, and white numbers? Well, the reason is we are looking at it is because of that implied volatility column. We are experiencing something that we call volatility skew. If you look very closely, the normal situation, what we would call contango, is that as you move further and further out of the money, volatility will start increasing. Now, that's normal, and that would happen on both the put and the call side. On the left, we have calls. On the right, we have puts. And if you notice something very, very interesting, and out of the money is the black area. So I want you to focus on the black area underneath calls. And then as we're closer to where black turns to blue or purple, that's what we would call at the money or going into the money. As we move further down, that's out of the money. And then the opposite is true for the put side. As we move further up, that would say that implied volatility is going, further out of the money. And we look at those readings. And it's very plain to see. We don't need to graph this or anything. But we can see very clearly that on the call side, implied volatility is much higher, closer to the money, and then it diminishes. That is opposite of the normal situation. And on the put side, it is the normal situation where volatility is close or smaller, and then as we move further out of the money, it's getting greater. Now, normally when both of those are showing that type of behavior, we call that the smile, because if you plot it, it looks like a smile. So what does all this mean? So analyzing the SPX implied volatility skew from your Thinkorswim screenshot, this thing right here, it's not really a screenshot, it's really live. So what can we see? And what can we interpret from this? Well, the way I look at it, there's bearish hedging going on, and they're pricing that in. And what does that mean? Higher IV in the deep out-of-the-money puts suggests that institutions are hedging for the downside risk. And they're expecting greater downside moves than upside rallies. But is that really what's going to happen? We don't know. They're just hedging for it because, we had that late day move yesterday where the market was moving. It moved down and moved all over the place because of whatever economic reports had spurred that kind of volatility. But then at the end of the day, it just dropped huge and then recovered. And so I think that spooked a lot of people in the market. So this could indicate an increased demand for put protection, meaning that a bearish move is more likely or perceived as riskier, right? Now, from our point of view, because all we do is we trade butterflies, this would mean that a directional butterfly is what we normally do. At the money or slightly in the money butterflies might offer a better risk to reward. Okay? So, in other words, if volatility is closer to the money, then that generally means that premium has delayed its decay in that area, or it's inflating the value of options. And so the closer we get to the money, or it's not like we have to say, okay, let's make a conscious choice to move closer. We're just going to find that on the call side, we're going to be able to get cheaper options, and they'll end up closer to the money as long as we just choose our standard width and our standard risk to reward, whatever that ratio is. Typically, our ratio is 1 to 9, 1 to 10, something like that. So we're going to find that call flies today, at least on the SPX, and at least at this moment, the way things are set up, they're going to tend to be cheaper. Now, of course, you can make a conscious decision and really take advantage of this by going a little bit wider with your call flies as opposed to put flies because they're going to be more expensive. Does that make sense? And let's see, do we have a big ass fly this morning? We're getting a little bit ahead of ourselves, so let me go back to the big head here and say nothing. What is going on? Ah, there we go. Good morning. How you doing? So there, you got a little bit of a lesson. I'm sorry, I can't talk because I haven't had enough coffee yet. A little bit of a lesson in volatility skew. And those are the types of things that we talk about every day, because volatility is really the driving force behind everything that we do in zero DTE trading. And we're looking to capture premium, but we adjust that exposure that we do every day based on where volatility is, where implied volatility is, where the historical volatility is in such a big instance, because we're always kind of forward-looking. Implied volatility is forward-looking. And yeah, if you want to learn more about that, then go down below to the link where you can see the Zero DTE Academy. Join now. It's growing like wildfire. I just started up last month, and it is already catching on. And I expect that within a few weeks, we're going to see it grow 4 or 5, maybe even 10 times. But yeah, mark my words on that, okay? All right, getting back to what we're here for every morning. I just wanted to inject that. I like to do a little focus every morning. We're going to talk about what is our disposition on our normal out-of-the-money butterfly trades. So given that context, we don't really do anything different. We're just going to wonder why are call flies so cheap today? And now you know. Of course, we could also play into that a little bit by making our call flies, because the volatility is higher on that side of the chain, we can afford to go a little bit wider, where we might look at a 25 wide, we might choose a 30 wide or a 35 wide, and then realize that, oh, wow, I'm getting pretty damn good pricing for this. And so, again, now you know why. All right, so what we're going to do next is go through our standard 3 things that we're looking for. Where's the volatility regime? Where's the, what width are we going? What's the direction of the market? And where's our structural levels that we anticipate to find an opportunity to actually get into a trade in the morning session? So let's start with that. And we need to go to Trading View. And we can see that, well, volatility is pretty much where it was yesterday at about 15. So we're looking at 15 to 25 wide. I can tell you already that I'm going to lean towards the higher side of the width based on what I've told you in the volatility scheme of things. But we're going to go through the, through everything anyways. These are what we call guides, right? It's not sacrosanct. It doesn't mean that we must choose 25 or 15 wide or whatever the numbers tell us. It means that these are our ranges, and then we have to look at the underlying data and then figure out what is the best possible lean into this market. What gives us our best edge? All right, so 15 to 25 wide. The next step is to look at the big ass fly. I don't even know if I have one set up, so we'll go look at that. We'll set one up if we don't. So that means we need to go here. Let's take a look at the ES because it's pre-market, and Thinkorswim doesn't know how to give me a butterfly on the SPX in pre-market. Maybe someday they will. A lot of other brokers will allow me to trade pre-market with the SPX, like Fidelity, Interactive Broker, TradeStation, and others. But Thinkorswim, Tasty Trade, not so much. All right, so we're going to put on at the money 50 wide fly on the call side. So I'm just going to choose on the call side. We'll start off with a 20 wide and then widen it. There it is. So we go to 60.75 and 61.75, and that will give us our 50 wide. It's priced in at $22. Even with such a low VIX, we're still getting favorable pricing. And yeah, so there we go. Got to make sure we have the dates correct. So the top date should always be tomorrow's date. And the bottom date needs to be today's date so that everything is priced correctly. Wow, isn't that weird? It's showing us that this kind of lagging here. There must be something else going on here. Is there something else? No. My volatility adjustment is good. I don't normally see that. And what I'm talking about is that the real-time P&L is not coming right up to here, which is really odd. Am I seeing something? Yeah, I don't know. That's unusual. But anyways, that's what we have. That could have something to do with that volatility skew, you know? In other words, there's some mispricing going on here, and we might actually be able to get into this fly even cheaper than $22, I guess. I guess that's what it's saying. Well, we'll find out. Anyways, we're at 22.80, so we bring that back to our our VIX chart, and we look at how that will adjust our widths. 22 is right in the middle, so we're looking at 20 wide. As I said, I am more apt to lean towards the high side if I'm going to be going with calls, and on puts probably a little bit narrower. But generally I use this big ass fly as my fine-tuning mechanism. So let's take a look at the direction. The direction is up, obviously. Although yesterday it didn't look like that was going to happen. I mean, you look at this candle action here. We were starting to go down and then recovered dramatically. But now we're above the market. And we can see that here, that price action here. So there was a good opportunity in the morning to take a trade right out of the gate. Moved very quickly up and then very quickly down. And then recovered out throughout the day dramatically. So had you stayed in that trade, you could have really profited. I'm talking about out of the money call fly. And then if you didn't get out in time, you would have been a sad person because it dropped really fast, and then finally recovered, and now has. I mean, this is just crazy action. This is neck brace time. All right, so that's really cool considering that the VIX is so low. You would think, hey, we're not supposed to see this kind of intraday swings, are we, during a low VIX? But that's what we have. And I've talked about this in previous episodes where I said that this year is going to be different. Yeah, we may be going up and the market may be going up, but we're going to see a lot of intraday volatility, and it's going to be exciting. So probably a chance to explore different strategies as well. So we are looking for our opportunity to get in. That means that we're going to enter this trade sometime after 9:30, which let me just see if I can draw that line right there. And between 9:30 and 12:30. That's what we consider the morning session. So this is the node demarked by the red and the green line. The green is the bottom of the node. The red is the top. Let me just zoom out so you can see exactly where that is. And turn on the volume profile. So this is the node that we're currently in right here. And we're actually above it right now. And we're now, it looks like we've jumped the creek. We've jumped this volume well here, low volume node, as some people call it. I call it the volume well. And now we're sitting up here. Man, I haven't even marked that up. I have to do that. So what I'm going to do is I'm going to mark the top and bottom of the node. So we'll create the bottom of the node, and all I have to do is just get it approximately in the middle of that very sharp delineation between high volume and low volume. And then I'll do the same thing with the red line. Just like that. So when I zoom in, I'll be able to see exactly where the boundaries are of this node. And then the other thing I want to do is mark up these little crevices in here because they're going to be significant right there. And that should be a yellow line because it's in a volume well. And we do have kind of a splitting of this node here. So I'm going to put a blue line right there. Right there. And we'll make that blue. I make these blue skinny lines intranode and the yellow lines intra LVN or volume well, so that when I'm zoomed in, I can tell exactly where I am relative to the profile. Because when I zoom in, I won't be able to see this big profile anymore. And so we'll zoom into a 5-minute chart so we can see the day. And there we go. So now I can clearly see where the node is right here. Let me just draw a box so that you can see also. So here's that node that I just outlined right here. I'm sorry, that's the old node. And then the node that I just outlined is up here. Yeah. Good job, Ernie. So there's the node that I just outlined. And then this is the node that we were in yesterday here, the much larger one right here. All right, is everybody clear on that? Let's see. We'll zoom out so we can see that. We'll go to a 4-hour chart. All right, so you can see where I drew the two rectangles here. So this is the node that we've been spending a little time in this past week, and then this is actually a larger node. It has greater overall volume. This is a little bit more expansive in terms of price range. But we've jumped the creek, and now we're in this upper node here, and so that's what we're really paying attention to. So let me just remove those now and go back, and so that we can see exactly where our opportunities are, because we're in a bullish trend. So we're going to put a call fly, out of the money call fly. So we know trends never move in a straight line. They kind of do this. And interestingly, that when they pull back right to these structural levels. That's what we're waiting for. All right. So we're going to be waiting for a structural level within the range that we're looking at. You know, maybe at the bottom of this. That's the top of that node, or if we do that, we're going to come through the creek again. So I'm not so sure that that's going to happen. This is probably the most likely one that we'll see right here. The most likely move today. Don't know for sure. Also, we have that volatility skew to contend with. Are we going to have a reversal when the market opens? There is the rub in all of this. We're still following our strategy where we're looking at the trend, we're going with the trend, but now we're looking at the pricing of volatility, and we find that there is a put skew on where the market is essentially making put options more expensive further out of the money, where in call options, they're less expensive. If they're less expensive, that means that the market's not anticipating going up that way. If it was anticipating market was going up, then those out of the money call options would be more expensive, but they're not. They're cheaper as you go up. You see how that works? And so that's what the options market is saying. Now, whether or not the market will go up like that is anybody's guess. But that's how the market is pricing it in right now. We're still going to follow our strategy and just take the favorable pricing. So we're looking for something like this, or maybe even a pullback to here, right? Or even to here. It can be anywhere. So there you go. There's everything. Let's get back to the big head. We'll wrap this up. All right. So we know the width. We're going to be somewhere around 20-25 wide. We know the direction. We're doing a call fly. We're expecting those call flies to give us slightly advantageous pricing because of the volatility put skew that we examined at the beginning. And so we can lean into it a little bit more without any extra risk. That's essentially what that advantage is. And we know where we're likely to pull back, where we are relative to the market structure and the profile. We know everything. So again, if you want to learn more about options trading and let the probabilities and volatility guide you, go down below and join the 0DTE Academy. It's going to be big. It's already getting big. Incredible community already. Man, if you want to be in there with a bunch of very experienced, like-minded traders that are all in there to help, and unbelievable resources, learning how to trade, learning how to set up your processes. It's really a pro-level academy. It's not much different than, say, if you wanted to join a prop firm. Actually, that's what I say about my coaching service. That is sort of the ultimate expression of our coaching service. You join our coaching service, we're teaching you how to become a pro trader. The academy is your first step. And all right, that's it. Time to go, get to work. Friday. Hope you all have a great weekend and happy trading. Coach Ernie out.